Now, let's talk currencies. Patricia Louis joins me from the Singapore newsroom. Trish, Russia and China planning to use their currencies to settle, what, bilateral trade? What's that about?
Well, that's as a result of one of the meetings on the sideline actually has during the BRICS meeting earlier this week. Both the countries have actually agreed to use each other's currencies to do some settlement of trades with each other. Now, the trade last year between the two countries, bilateral trade actually reached 57 billion, so it's not a small amount. And right now, Russia plans to sell oil to China denominated in ruble. Now, traders said that it will take a while before the contracts are actually settled because of the currency restrictions in both countries. But it could actually mark the start of what both the two BRIC countries have been trying to do, which is to move away from dollar-denominated sort of settlement into other currencies which they believe are less prone to fluctuations. So we might see it's not so easy to implement yet, because the Chinese yuan, as we all know, is not fully convertible. So it's going to be interesting to see how they actually try to resolve the technical issues side of things, which is actually the main reason why they have trouble coming up with an alternative to the dollar, the technical side of these things.
But Trish, would such comments have any impact on the dollar?
Well, not at the moment. Well, the dollar is weaker this morning, but it's not because of those comments. Traders are actually rolling back expectations on the Federal Reserve interest rate hikes by the end of the year. Now, as far back as last week, we saw that about 40% of the market was pricing in about 25 basis point rate hike by the Fed. Now and market seems to be rolling back the expectations now following the weaker than expected CPI numbers last night, and they scale it down to just about 30% chance of a rate hike by year. And traders are saying that the Fed is pretty concerned about all these rate hike expectations, which seem to have come up out of the blue, and they are saying that they may use the the next FOMC meeting to actually give a very strong signal to the market that they probably are a little bit ahead of themselves at the moment in pricing in a rate hike expectation.
Trish Louis, thank you for that.